You started in 2014 after the oil price crash, and obviously you kind of maybe thought the market would play out differently over the last 8 years. But let's kind of, for somebody that's not as in tune with what's happened the last 8 years in oil and gas, give me like an overall overview of what the market looked like post-crash. You know, who are the main players, what was going on, what was the narrative, and then I kind of want to walk what's changed over 8 years, because there's a lot of different things that have changed. ESG, investor sentiment, we want cash flow, we have more data on fracking, all of those things. So I kind of want to paint a picture of, from your view, having been so kind of patient in this industry for 8 years, how things have changed and kind of how your mind has changed with it.
Yeah. So we launched it we wanted to launch it in January of 2015 and launched it in May of 2015.
Okay.
But can still sort of walk you through the whole thing. So, I was active in oil markets prior to launching Bison. So really experienced it from the end of the last cycle and was investing professionally in oil and gas since 2007. So I guess my joke is that I've been doing it since the last time it was popular. Or profitable, or both. And so that no one thought that the 2014 crash, one, that it would happen, or two, that it was as big a deal as it ended up being. And so one of the things I'd say that's colored the market, and we'll go through kind of, I think it's a really good exercise. It's not something I've done in a little while, and there's a real risk that my take on it now is going to be really different than it would have been if you asked me 3 years ago or 5 years ago. There's a lot of sort of mental revision that we do. And I spend a lot of time in evaluating investments, making sure that I sort of unwrap my biases and try to almost fade them, trade against my biases, just because it's so important to do that, especially in public markets where a lot of pricing is driven by sentiment rather than by intrinsic value, especially in the short term. Opportunities open because people hate something or think something or whatever. So there's a lot of risk, and I guess I'll caveat that. So it used to be that oil and gas producers, that there was this idea that oil was trading in a band, and that the upper end of the band was OPEC's ability to sort of flood the market at, let's say, $120, $130 a barrel. There was oil that was off the market from Iran and Venezuela, and increasingly over time, even though there was some that was getting sort of smuggled or whatever. And so there was this idea that there was an upper band, and then there was a lower band where OPEC and others would sort of defend the market, cut production, and there was this idea that oil would be in this 80 to 120 price band. And so if you have a stable price band, you have what's happened up until, I guess, this year in other asset classes, where you end up with a sort of high multiple that like creeps higher as cost of capital declines, as markets mature. And it had gotten to the point where upstream producers that, incur all kinds of risks like we know now, and all kinds of uncertainties, upstream producers were trading for, let's say, 7-ish times EBITDA. And in some cases had no free cash flow because they had to reinvest all their cash just to keep production flat and pay their debt and pay their people and overpay their managements. And so 7 to 8 was sort of the norm. If you bought something really discounted, maybe you got it for 4 or 5, but it had a lot of hair. And then the best companies were maybe at 10 or 11 times EBITDA, but they were growing or some other sort of reason. And so coming into 2015, there was this essentially half off sale where, especially on the small caps, you could buy these things for, let's say, 4 or 5 times EBITDA. And they were all growing because at that point, companies were still reinvesting more than their cash flow in drilling. And there was a concept that they were supposed to grow, and that's like what they were in business for, and that oil was scarce. And so you start in this thing where there's this expectation, even though Saudi and Russia were sort of dumping oil in the market, and there wasn't this lower band, there was this idea that it would just sort of reset, whether because shale was way more expensive, which it used to be, or because Saudi or others would just sort of give up and cut back on their production in order to reset the market back to that band, because the band was very, very valuable to them. And It was a fiscally irresponsible decision on their part, frankly, in retrospect and at the time for them to do what they did, but they did it anyway. So that was kind of the frame was, hey, there's things that are cheap. There's things that were very cheap and things that were kind of cheap. And the idea was to come by the very cheap things and be careful to not own things that were too levered, to not own things that were too problematic, and be able to get the uplift from this sort of temporary mispricing. So that was the mindset in 2015. That was very common. It wasn't a differentiated approach. The differentiated approach was to do these sort of special situations in a portfolio of public equities as a fund. That was a different thing than consensus. So I'll stop there, and then happy to sort of walk you through the rest of it. But I don't know if you have questions or if you want to sort of set it a little differently, or if you want to keep going from there.
No, I think we can keep going. I think the only thing I would ask is, you said in retrospect it was poor fiscal decision making by the Saudis, and I think what you're alluding to is that they kept pumping the same supply and kept prices down for a long time. So they sold more of their oil barrels in the ground at cheaper prices than they probably could have. Is that right?
Yeah. So they, in 2014, at an OPEC meeting during Thanksgiving, they announced it the night of Thanksgiving. They decided to increase their quotas substantially and flood the market in order to put U.S. oil shale out of business.
Yep.
And that was essentially, they basically said it. And their thought was that the break-even cost for shale was roughly $80 a barrel, which they weren't wrong about. It probably was actually $90. And they saw that shale was growing, which it was. And they thought that if they lowered the price by raising production temporarily, they could force these competitors and this new supply stream off the market. And they had had bad experiences in covering for growing fields in the 80s and in other prior periods. So in the 80s, they were absorbing from essentially 1980 to 1986. They kept pulling supply off the market. And eventually, I think it was 85 or 86, they just gave up. And because in the North Sea and other places, there were millions of barrels more per day of production than they expected when they started pulling production off in the early 80s. And so they just gave up and flooded the market. And ironically, actually, that's one of the things people don't really talk about this, but it's one of the things that caused the fall of the Soviet Union was the Saudi flood of oil production. The Soviet Union was getting a lot of their hard currency from their oil sales. And when oil went from, I don't know, like 30 or something US dollars at the time to 10 or 8 or something, it really hurt their ability to finance their sort of communist experiment. And so that's sort of the backdrop, was trying to put shale out of business. And it was a miscalculation for a few reasons. So one, shale was going through a productivity and cost curve where costs were falling and wells were getting more productive. And so it turned out that shale wasn't really the swing production that they thought it was. And so there were these slowdowns in development intermittently. So there was a big slowdown in early 2015 after the price crash got sort of incorporated into budgets. There was another big slowdown in 2016, similar thing. There was just this huge crash end of 2015, early 2016. That was sort of a culmination. And then another slowdown in 2020 when the Saudis and Russians got into a price war. And so each of those, there was a brief slowdown. But the reality was that from, let's say, 2012 to 2020, essentially, that was sort of the peak, or maybe 2018 peak of shale productivity and cost reductions. Shale wells got essentially twice as productive, and their break-even costs went down more than half.
Yeah. And
so that was a really big change, and I think they just didn't understand it. And in the end, let's say they could have gotten $75 oil through that whole thing, shale probably wouldn't have grown that much differently than it did. Maybe there would have been an extra 1 million barrels a day produced that Saudi and OPEC could have withheld from the market. And in aggregate, just the amount of reserve depletion they experienced, the amount of sort of fiscal suffering they experienced, the amount of instability in the Middle East and elsewhere from this sort of volatility, to me, it seemed like a very here, as well as sort of through that process, it seemed like a very poor decision to choose to not more actively manage the oil market.